Well, we're very happy to have Paul Schmelzing speak to us today. And it's a great opportunity to hear about long run trends in the long maturity real rates 1311 to 2021. I love history, so we'll learn a lot about history today. So thank you very much for being with us.
I thought the world started in 1959.
Well, thank you very much, John, for having me today. It's great to be back here in person, even though the idea was to escape the Boston rain for a couple of days. That part didn't work, but it's great. I'm glad to be here. And this is a brand new paper. I'm glad that one of my co-authors, Barbara Rossi, is joining virtually as well. So all the questions that are above my pay grade go to Barbara. And let me start right away. What is the motivation of our new paper? So arguably, interest rate trends are always topical, but you can easily make the case that they are particularly topical right now. After the moves that we've seen in recent months, after the experience in London, interest rates are top of the FT almost every day. Now, but in the summer at the Sintra Forum, characteristically, monetary policy makers like Andrew Bailey declared that the era of low interest rates and low inflation is over. At least that's how the FT and many others interpreted their speeches and their research papers. So we think it's a great point.
Aren't they the same ones who said it was going to last forever just about 6 months ago?
There's a decent overlap, I think. Yeah. But let's look at this chart to start with some of the motivation here. We see here US 1 year real maturity rates, two different ways of adjusting these rates with inflation. And I think this already puts the recent historical inflection point in some perspective. Okay, so there are many different ways of constructing ex ante real interest rates, and we go through some of the versions. But at least here in this chart, it still seems that compared to earlier business cycles, compared to earlier peaks in the US economy, we're not actually at comparable levels. It's a far cry from it in many ways. So the red shades are obviously recessions that you see here. So we had a drastic move, but in this measure, we're still actually in negative territory. But our motivation goes back, obviously, pre these summer moves, and it goes back prior to the financial crisis, in fact. So there's a long literature actually in both finance and macroeconomics on the basic properties of real interest rates. Okay, people have looked at this for a long time, trying to find out how effective is monetary policy actually. And obviously, those working in markets or in the applied field, they want to make predictions and think about future trends from past properties of real interest rates. So some of the relevant papers are listed here. And overwhelmingly, the consensus in these papers that have applied rigorous statistical analysis, econometric discussions to the subject, have found that real interest rates are best characterized as having a unit root. In other words, essentially being a random walk.
Wait a minute here. Something with a unit root explodes. Real interest rates never go above 50%, never below negative 50%. You can't do it on a unit root. No.
But I mean, there are exceptions like pharma. We'll go into some of the qualifications here in a second. But what they all have in common, in our view, which is a deficiency, is that they look at short maturity real interest rates and post-1945 data sets. Okay. However, it has been known for quite a while, and this is literature that evolved out of FX and currency statistical investigations, is that these kind of analysis are very deficient if you look at rather short samples. The statistical power of your analysis rises dramatically if you look at long samples here. Okay, and so Jeff Frankel and Lothian and Taylor are prominent papers that have applied these insights to the British pound and French franc crosses over time, for instance.
Sorry, I jumped ahead and made your point.
Right, yeah. And their argument is that once you extend the sample of these data sets, your results dramatically change, and your statistical power of these econometric analysis dramatically improve. Okay, so it can make a radical difference if you look at a post-1945 interest rate sample, or a 200-year or a 300-year interest rate sample. So far, however, unlike the FX space, we do not have similar, really rigorous long-run analysis of real interest rates. And particularly, one argument we are making is that it is not really intuitive why most of the existing literature has looked at short maturity interest rates when debating things like secular stagnation, the long decline in US productivity, these kind of multi-generational trends in the economy. We strongly suggest that the right asset that you want to look at is a homogeneous long maturity interest rate basis here. And this is dearly missing in the literature now. So we are exploiting not just big advances in the interest rate space, but more generally, we find that finance and macroeconomic researchers have kind of missed major advances in econ and financial history that have been going on over past years. So I will show you in a couple of slides how dramatically in the post-Angus medicine age, for instance, our understanding of long-run GDP trends has changed. Our understanding of long-run population growth trends and dynamics has changed. This hasn't really arrived in finance journals and econ journals yet. But we think that for the first time, we can link these new financial data sets with other macroeconomic variables and learn a lot about long-run correlations and interactions that we have not known so far. Obviously, why is this relevant? I mentioned secular stagnation. The debate is very much ongoing. But these two variables I mentioned in particular, output trends and population growth, i.e. demographic trends, have attracted particular attention in the literature, obviously. And a lot of people have made the claim that declining birth rates in advanced economies are the reason we are seeing low interest rates, okay? Declining productivity, a secularly downward trend in productivity, is the reason we are seeing low real interest rates. And like Robert Gordon have looked at this historically, Barry Eichengreen and many others. We will go through some of the nuances here. What do we do in this paper? So I mentioned a couple of things, but we take advantage of a new multi-century, long maturity, real interest rate data sets for all of the advanced economies since the Renaissance, basically. This was started in my dissertation. It has become more and more nuanced, and we now have a high frequency, voluntary, long maturity data set for 8 leading economies covering over 80% of advanced economy GDP over time for 700 years. We then apply this new data set to the full range of the latest statistical tests on stationarity, on breaks, on Andrews-Zivet tests, everything you can find in the literature. And we really try to drill down hard on, okay, what is actually the nature of real interest rates over time? What are the properties? What kind of animal are they? Our key result is that we find once you extend the sample length, this idea that interest rates are a random walk is firmly rejected, okay? So we find strong evidence across all individual countries on all different global levels that we can construct, on different inflation expectation approaches that we can construct based on existing literature. Firmly, we can reject the idea that interest rates have a unit root, that they are a random walk over time. Okay, this has many important implications, but we'll focus on them later. We can replicate existing approaches. Andrew Rose, for instance, wrote a famous paper, Is the Real Interest Rate Stable? We have a couple of these prominent papers and show that we can replicate their results on the shorter span with their assets, with our inflation expectation approaches, etc. And then we look at the question whether we had a recent inflection point in global interest rates. Okay, first of all, from the perspective of the whole secular stagnation debate that focused on the 1980s, and there are many papers that think something big happened in the 1980s, not just in monetary policy, think Paul Volcker, but in productivity trends, in demographic trends. So we look at this inflection point and 4 other big inflection points over that 700-year period, and try to test a couple of big narratives that have existed over years in the econ history, financial history space, including the North Weingast thesis that got Douglas North and Barry Weingast the Nobel Prize for their idea that something major happened in the late 17th century in global capital markets because institutions improved dramatically. However, we find that only really the Black Death in the 14th century and a major financial crisis that happened in the middle of the 16th century are robust inflection points in global capital markets. 1914, 1981, both pop up occasionally in individual country series. They when we do chart tests, they are confirmed on a couple of levels, but far less than you would expect given all the narratives, all the major debates about these inflection points, about the shift from fixed to floating exchange rates in 1914. Only 1349 and 5057 are confirmed in our analysis.
Why did you start where you started?
So that has a couple of technical reasons. The early 14th century is the first time that these countries start issuing on a high frequency level consolidated long maturity debt. Secondly, it is the first time we can measure high frequency inflation series. Robert Allen famously constructed seminal inflation series. He starts in the early 14th century. Okay? We want to use his definitions and also other definitions, but this is the natural starting point on the inflation.
Are there other studies not so formal as yours that go back 2,000 years or so?
Well, the most prominent is probably Homer and Silla's history of interest rates, which I will talk about.
Same story, right?
In many ways, it's not the same story because okay. I will talk about it in just a second.
So I do back in the unit root days in the 1980s. I mean, in some sense, to know unit root, you don't need to have a consistent data set. And so one observation, like interest rate was 6% in ancient Babylon, or someone came up with. So that just one observation, 6% in 2000 BC, ties down the unit root properties pretty strongly. So it's back in the old days.
Well, ties down. In what way?
If you know it was 6% in 6000 BC and it's 6% in 1450, you kind of have some strong evidence that this thing is not wandering arbitrarily far away. It's not trending.
That's why I said it seems like it's consistent. It seems like the longer history is consistent with this shorter history.
Yeah, it's true that it's mainly about the sample length rather than the number of observations. That's true. So we can bring in Barbara Rossi on some of these points as well, where we play with Monte Carlo assumptions. And the final point we're making, I mentioned these new, very nuanced GDP series that have evolved, and I think they are a treasure trove for macroeconomists that haven't been exploited. We then study the correlations of real interest rates with long-run GDP trends and with long-run population growth trends. Remember Alvin Hansen's presidential address in 1938? It was squarely about population growth as the driver of the secular stagnation environment. So these two variables are the most natural and prominent ones to use here and try to pin down the relationships. Okay, very quickly, what you see here is basically the data that has been used in a number of prominent studies. Marco Del Negro, for instance, and basically it goes back to the JST data set that Joda, Schulrich, and Taylor have constructed. Many people are using it. But you see the issue here. One is they start obviously in the late 19th century. They focus on short maturity assets, as I mentioned, and they splice together very different animals here. Okay, so here in this series that has been used many times, people splice together commercial paper rates, in the first half of the sample with UST bills, which only emerge in the 1930s, actually. So this is not really an intuitive way to study secular trends in capital markets and these growth expectations that should be priced into long maturity assets, etc. So the first observation is, I think that on a definitional level, not just on a sample length level, we have major issues in these series that are being used to make these major claims. And the Hamilton-Hatzius study is another example where they use exactly this type of data. Here, the red line now is Homer and Siller's data that I add on top here. So I'm a little bit unfair to Homer and Siller because this series is simply showing you their definition of the lowest nominal rate over time. So it's their approximation of the reserve currency center pieced together. Okay, but I would argue it's characteristic of the data quality in many ways because they use English-speaking sources only. They never went to archives or collected new primary data in any way. And pre-1800, there are significant gaps that for all the countries involved, even the leading leaders. And so what we really want is a high frequency new reconstruction of global real interest rate trends to study the properties. Okay, and for the first time, we can do that with this series, okay, with the blue one here. This is a homogeneous, voluntary, long maturity, GDP-weighted interest rate series that you're seeing here, starting in the early 14th century, okay? This is actually using an inflation expectation approach that Homer and Siller also suggest somewhere in the book on the 2 pages where they talk about real interest rates, okay? Which we apply to this series. It's a progressively lagged definition of inflation expectation. We can go into some of the details. The major drawback, however,
You're gonna tell us more about where this came from, and
we can talk about it. Yeah.
are you going to, or should I ask that question with the graph in front of us?
I have one slide coming up that talks about some of the sources. I wanted to make one technical point as well. So one issue with this short maturity focus that the literature has is that historically sovereigns, governments did not really issue short-term debt. Okay, so if you look historically, the almost exclusive focus of debt activity of sovereigns, starting with the Venetian Republic in the 14th century, going over the Holy Roman Empire, even the UK in the 17th century, it's firmly on perpetual long maturity debt. Okay, and here are some of it's just a selection of cases where we can exactly reconstruct the composition of sovereign debt. Okay, in blue you see here it's a very, very generous definition of short maturity debt. Okay, and we see the breakdown. So this includes stuff like non-negotiable tallies that they sometimes issue, i.e. tax claims, IOUs that they sometimes issued. Okay, that's my definition here of short maturity as well. So the point here is historically public debt activity was firmly in the long maturity spectrum. Okay, so to construct a coherent series forces you, once you recognize this, on the long maturity spectrum actually. Okay, and I don't know how many people know this, but when is the first time that the US government issues regular T-bills in regular quantities? That's 1929. Okay, and that's the reason why these series have to start in the 1930s with actual public short maturity debt. It's similar for the UK.
Do you guys think about why governments can change so dramatically? I mean, I got some pet theories because I want them to issue perpetuities, but I don't know if you guys have done some work on this.
I mean, we discussed it a little bit in the pack as well, but it's probably a separate paper to drill down on that. But I'd love to hear your theories if you have some. Okay, quickly on the underlying data here. I mean, I won't talk about this too much because I think I've talked to some of you in February on some of the construction details, but we can definitely go into it in the Q&A if you want. So here are a couple of examples of these primary sources. And I want to stress that what I'm doing is a combination of primary, secondary, and printed primary sources, okay? So there are Italian economic historians who published a ton on the Venetian Republic in the 19th century, etc. So this does not come exclusively from archives. It's really a synthesis of many different, but coherent, homogeneous sources. Here on the left, you see a contract from the year 1546, where the Fuggers, the largest bank of the 16th century, by far larger than Lehman as a share of GDP in the early 24th century for comparable institutions, lends to the English crown in Amsterdam a sum of £152,000 at a 12% interest rate. It's secured, so they specify the collateral secured by letters of obligations of the city of London, etc. And this document, for instance, is held in the National Archives in Kew in London. On the right-hand side, you see that we talk about this in the paper, but the existing JST dataset in large parts actually relies on Homer and Silla. They don't collect new data from archives either. So here is an example from the 19th century from an archive in Frankfurt, where a lot of the merchant banks in Europe were based prior to World War I. This is from daily sovereign yield records that the business paper in Frankfurt published at the stock exchange every morning. So these are files that we still find in archives. More and more, this stuff is digitized, okay, fortunately, but a large chunk is not. And so you have to get your hands dirty and go to the archives still. Okay, how does it look like? Okay, so here we see our key result. Global real interest rates are trend stationary. Okay, I won't show you all the tables. It's because it's a bit dry, but you can see them in the paper. We can confirm it at least the 5% confidence level for all the individual country series and for the global series. Here you see a GDP-weighted version of the global interest rate, but we can weigh it in different ways. We show you different ways of weighting these individual country constituents. And the blue line here shows you one version of drawing a trend through this, okay? You don't have to believe your eyes. We show you in the paper as well that it's really downward, a downward sloping line, okay? And it's trend stationary. We also use not just ADF, but Zivit Andrews and other tests, and they all come out with the same result. And I mentioned different inflation expectation approaches. So, for instance, in the Hamilton and Hatzius paper, they use an autoregressive model to model inflation expectations. We use their approach as well, and also find the same result, that global interest rates are actually trend stationary. Okay, so interesting effect. Obviously, by 2021.
Could you say something more about where these inflation expectations data come from before you start auto-regressing them?
Yeah, so I mentioned Bob Allen, who is the seminal source for long-run inflation series. I mentioned his data is based on silver prices. He constructs consumption baskets over time, but they are dynamic. So he tries to exactly reflect what the average artisan and the middle class person over time consumes. Okay, what kind of things go into his basket, and he measures it on a silver price basis, and we take these benchmark series. But I show in my earlier work that you can also use local currency as local currency basis, etc. You can play around with different.
So basically, it's my inflation expectations in year T are just a function of sort of year T, what actual prices were in year T-1 and maybe year T-3, or is it just an AR1?
So here we use a 7-year lagged version. Okay, so you want to match the maturity of the bond to the best extent possible, right? So the average maturity of the bond is 13.2 years over time, if you want to be precise. So ideally, you can also argue we should use a slightly longer measure. I mentioned Hoover and Siller use a 7-year progressively lagged. So this is what we want to try here and test. So this is what you see. You see it being adjusted with 7-year progressively lagged past inflation. So we overweight the T-1 year. It has a 40%, 42% share in that overall number, and then progressively goes down. Okay.
So I want to make two objections because I cut my teeth in the 1980s on the unit root wars. So what's abundantly clear from the graph is that there's a bunch of short run mean reverting movement in this series. Done. But whether the slow downward trend is captured by a deterministic function of time or by a stochastic, something with a unit root of time, is really that statistical tests for that really basically have no power. We just, that could be 5 minutes of data or 5 centuries of data, but there's a bunch of low frequency movement, and you're trying to say, is it a deterministic function of time or a stochastic function of time? And that, I thought the conclusion of the whole unit root literature was you just can't tell. In addition, you also have to think a little bit and put some theory on it. So if you think it's a deterministic function of time, then by the year 3000, we will have negative 50% interest rates. Well, that doesn't make any sense at all, right? So piece one of economic theory argues against a linear or a deterministic trend unless it's going to exponentiate down to zero or something. You can't tell linear trend from exponentiating to zero. Second, long-term interest rates should not behave this way. So I think it's perfectly natural to think that your data has measurement error in it, but long-term interest rates don't have a very high frequency mean reverting component. They should look at horizons like their maturity, which for a perpetuity is a lot. They should look a lot more random walky. In fact, there's a theorem that says the infinite maturity rate can't change at all. But the appearance of a lot of this mean reversion, I think we would have to think of as measurement error, not true measure of the perpetuity yield in the economy at that time.
Well, in an infinite horizon Ramsey model, the rate would be the rate of time preference plus the elasticity of margin utility times the Herod neutral rate, right? So there could be trends in those things.
There could be trends. It was the question: can there be all this high frequency up and down in a long term? It's very hard to get a model that does that.
But wait, can I just jump in here, John? It's not just measurement error. It's that the characteristics, in particular the liquidity characteristics of what's being traded, may fluctuate over time. And I don't see any reason why theory rules out the possibility that has some of these high frequency movements.
Thank you. Yes.
That's really a friendly amendment to your line of argument.
Yes. You don't want to think of this as the measurement of a frictionless financial market, consumption growth to the gamma and underlying productivity trends, that real rate, but you're exactly right. And certainly in these historical markets, there's going to be liquidity and supply effects and all this other stuff.
Yeah, but the long run's got to be a function of the marginal saver, right? The marginal supplier of the capital. And
well, we're all marginal in standard economics. We're all marginal.
Well, but I mean, those are likely to be, in this instance, people with very long horizons, dynasts, for example, in the early period.
Who are present in markets at the moment you're selling the bonds.
Fair enough.
So we stress in the paper that we do not look at the drivers of this series in depth in this paper, okay? So i.e. liquidity, sovereign default risk over time obviously change, okay? We are not disputing the fact that markets are much more liquid nowadays than they were in the 14th century. There were obviously dramatic institutional changes too. So sovereign default risk is on a different level in the 21st century than for some sort of rural duke in southern Germany in the medieval period. However, we believe that the stationarity inside supersedes these questions about what exactly drives the trend here, okay? And that is really for a companion paper that we are currently looking at to filter out what is it that is driving this series. I would stress
One have a downward trend. I'm not objecting to that. The question is, can we
you're talking
tell-
about the high frequency. Yeah.
There's the high frequency stuff, which is interesting. There's a big downward trend, which is interesting. Whether that's a stochastic or a deterministic function of time, I just would say is a lot less sure than all the econometricians wanted to tell you that they can make it.
On your specific unit root point earlier, I wonder if Barbara has any thoughts on that.
We shouldn't fight about unit
Okay.
root econometrics now. I'll send you some papers and we can talk about it later.
So one more thing I would point out is that we are really seeing these high frequency movements even in the most robust subsamples that people have looked at. So here's the UK starting in 1600 going to 2021. Yeah, this is based on the Dimsdale-Thomas data set, the Millennium data set that the Bank of England released. Okay, for sure.
So these are now government perpetuities. It's not. Yeah. Okay. So much more consistent.
So, but they all are. I mean, I mentioned these are all long maturity instruments.
They're all long maturity government
Instruments. Yeah, even in the other countries. But look, if your argument is that I have measurement errors, then I would say we take other people's approximations. Okay, here we the UK, where a lot of people would say we have the most robust existing data on UK perpetuities. Okay, and we see the same downward slope, and we see perhaps to a little lesser extent these high frequency ups and downs. Okay. I could show you the same for the US starting in the late 18th century. We can come back to it. But again, if we just look at the UK, if we just look at the US, we confirm these key results as well. Okay, so it's not a function of our putting together these individual series and countries. Okay, that's
If you grab, I would be interested to see the nominal yields. We're under the gold standard.
right.
So
Okay,
in some sense, nominal is real, and then there's the question of your price level. You guys all know, but still,
I can
to
show
what
you nominal
extent
series
is,
as
to
well.
what extent is this variation coming
Right.
from
I mean the
nominal yields versus from your expected inflation series is interesting.
Yeah. I can show you that I think the assumption that nominal is equals real in the early period is not quite point. We have
Well, there's price level variations.
the literature on the price revolution.
Like 1800, I doubt that in 1800, the nominal yield on a perpetuity was minus 10%. I don't know if that's even possible.
So you're seeing real.
Sorry?
You're seeing real.
Right. So
No.
I'm guessing the 1800 data point comes from a big shock to however you're
Sure,
measuring
Napoleonic
inflation,
Wars. Yeah.
not a big shock to nominal yields.
Yeah. It might well be true.
With the UK here, I mean, how much of this, the downward trend is driven by pre-1700? I mean, because it almost, I almost wonder if there's a North story here with 1688.
So we spliced the samples. We do balanced panels as well, where we say, look, obviously the US, UK, they come in later, okay? On some of these series, the US only starts issuing in 1800. So we let
Actually,
all of these
I'll give you
series.
1776 as the break-in trend. So Adam Smith, the publication of Adam Smith, that's where that, I'm very good at trend breaks by eye.
Is the kink similar to the country? You sort of change the slope?
It's very similar, yeah.
I mean, it's almost zero.
But it continues. So if we let the series start in the 1850, for instance, okay, we continue to confirm so we do these balanced panel exercises. So it continues to trend downward even after 1800.
I can't help but asking about beforehand. I guess you'll go back to that, huh?
Say again?
I can't help but ask about ancient history. Just
Oh, okay.
makes me, you have to
about
know
some-
ancient. It makes you really want to be more ancient. I don't know.
There's one more There's just no bond market then, so
Right.
you can't do it.
Well, there are individual observations, right? The ancient Babylon observation we have.
They're not long-term government securities. You're just
No,
looking at
there's-
short-term private.
Right, well, there's also, they're not short-term, they're like land, rental rates on land, for example, is an observation that goes back to. BC.
And there actually
That-
are-
that's-
There actually is
never
a
about
discussion of
1%.
futures in Hammurabi's code. And one expects that Hammurabi's code was probably adhered to in Hammurabi's time, given the result if you didn't, so.
Yeah, I would acquire, I would have to acquire new language skills if I want to get some.
Well,
RAs.
we know, we're pretty sure in ancient, let's take the trend back, this is like, wait, these linear trends. Let's go back in time 1,000 years.
Well, Walter
I'm pretty
Scheidel and
sure that the
others have
real
done,
interest rate,
and
whatever
Peter
it was-
Timmin, they've looked at the Roman Empire.
What do we show?
Okay,
now?
it wasn't 50 to 100, it wasn't 100% in the Roman Empire. If you take that blue line and go back 1,000 years,
Yeah.
it's got to flatten out in the other direction.
That's an exercise I would not undertaken because the argument goes that consolidated long maturity debt comparable to US treasuries, they start in the 14th century when the Venetian Republic issues the Montevecchio bonds for the first time.
Yeah, but-
So the type of assets in the Roman Republic and in Babylon are not.
The shadow price of those assets. If you were to sell, let's give you a time machine, you go back to Rome. Hey, I got an idea. I'm going to sell you a long-term bond. You're not going to get a yield of 200% of that long-term bond following the blue line. Productivity, consumption growth rates, whatever, didn't change that much from Rome to 1300.
Well, I would just say we can't say. I mean, because the assets are not comparable.
I don't think they're comparable here either. Unless you're prepared to show us that bid-ask spreads were similar back in 1400 to what they are in the 20th or 21st century, they aren't really comparable. I mean, even off the run and on the run US government bonds of the same duration have different expected yields. I defer to John Cochrane, but my understanding, it's well established in the finance literature that there's strong relationships between expected yields and the liquidity characteristics of high grade bonds with little in the way of default risk. So
Well, today I can get you 1% out of that, but I can't get you 10% out of that.
no, but if you take current bid ask spreads and you scale them up by a factor, I don't know, 20 or 50, I don't know what's the relevant scaling up back in 1400, but 50 doesn't sound to me completely out of bounds and 20 sounds plausible. That could get you a big change.
I'm not so sure because the clientele for long-term bonds, the reason they issue perpetuities is that, it's Downton Abbey and you want to put something in and live off the coupons. So there isn't really an active amount of trading. That's why they
Maybe.
sold
Well,
long-term
yeah,
bonds
but
the first
okay,
place.
fine. So, but then you're telling us that the characteristics of the buyers and sellers were very different, which would be another kind of non-fundamental reason. This is back to your measurement error point. The measurement error here is really measurement error relative to a frictionless macro benchmark, as you said, but relative to other things we think matter for yields on bonds. There are other things that the finance literature would direct our attention to, including who trades and what the liquidity characteristics of the assets are.
But I think that this goes in Paul's direction. There's data and then there's explanation. One of the explanations is the nature of consumption growth change. The other explanation is the nature of markets and the clientels and the
Right.
liquidity of change.
Exactly. But then when you go back to his claims about, casting doubt on macro fundamental stories that emphasize population growth or output growth, well, maybe those claims are actually right if in the 20th century. I don't have a dog in this race. I'm just saying conceptually, it's possible that those things are right. It's just that by the time we got to the time period that modern macroeconomists look at, some of these other characteristics, these financial characteristics, let's call them, had stabilized. So I think if you're going to start drawing inferences about whether these data cast support or doubt on certain macro-based fundamental stories, you cannot avoid the question of whether these departures from the frictionless benchmark have stabilized over time.
You know, I obviously this is something I get all the time. These questions. I would emphasize again. We're not talking about the drivers. Okay, we're not trying to explain the downward trend. We acknowledge that there is a big story going on with liquidity. There is a big story going on with sovereign default, obviously, and state capacity, etc. There's a lot going on. What you're seeing here, however, is a radically improved new way of measuring to the best extent possible what is going on in the relatively most liquid asset over time. Okay, so the Venetian government bonds, the long maturity bonds, they can be used as collateral in private loan contracts, for instance. They can be used to pay your tax liabilities to the government. They are owned internationally by German investors, by Spanish, etc. So we are tracing relatively the most liquid instruments over time. Okay, even though in absolute terms, of course, there was a trend in liquidity. Of course, there was a trend in sovereign risk over time. But these debates, again, the insights that we are dealing with a stationary downward trend, we think supersedes these discussions about what is driving it. Okay, what you see here now is our investigation of the trend breaks, the inflection points in the series. Here, these red flags that you see are the 5 major inflection points that we test based on a huge literature in economic history and finance, etc., that has made large claims about each of these 5 points over time, beginning with the Black Death in the 14th century. So people like Homer and Scylla themselves say that the Black Death was the inception point of modern capital markets. Steve Epstein, for instance, and Gregory Clark think that the Black Death is the most important event in capital markets over centuries. Okay, so this is a natural one to test. The next one, often overlooked, is 1557, which there's a lot of literature from the German historical school in the 19th century that talked about this, because the Fuggers were at the forefront of this. It was perhaps one of the largest financial crises ever in advanced economies. Okay, people have forgotten about it, but there are marvelous works from 1893 by a guy called Richard Ehrenberg, who wrote a 1,000-page book on this. So simultaneously, France, Spain, and the States General default in 1557, and about 50% of global GDP is in default suddenly, and it triggers a multi-decade financial crisis around the world, and brings banks like the Fuggers to the brink of default as well. The by far largest bank in early modern history, far larger than the Medici Bank, etc. If we search for it, we find abundant, very interesting sources on this event. So it's an.
Are these real yields or real ex post returns? So I would have thought you'd see a negative if it's an ex post return. Where do we see that you lost? Okay, where do we see that you lost half your money in government bonds on that date?
Well, okay, they don't
because you're just measuring ex ante yields.
Yields, yeah, we measure yields. Yeah. Also, I should say they don't necessarily default on these instruments that we see here.
Right.
Okay, so for instance, Philip II, the so-called debtor from hell, only ever defaults on short maturity debt, on the so-called asientos. Yeah, and that brought him this infamous place in history, but never on the long maturity.
Do you have just a historical background? Very interesting that interest rates rise from looks like 1300 to 1350. Is there any story for that? I mean,
yeah, correct.
Did they see the Black Death coming, or?
So I talk about that a little bit in my earlier work. So what happens is, of course, you wipe out half of the population, your capital per person suddenly jumps.
No, but this is before
and what happens is that you see a massive consumption boom by the people who survive the Black Death.
But that's after the Black Death. The line rises.
Yeah. So after the Black Death, the people who survive suddenly endowed with double their wealth.
I'm sorry, isn't the yield as of the date? how does the yield at date 1320 have anything to do with what happened in 1350?
Oh, you're saying prior to the Black Death? we
Yeah,
also
prior to the
already
Black
have
Death,
it.
we got these.
Okay. I thought
We
you were talking
reverse
about-
almost all of your trend, and we start up at about 7% from 1300 to 1350.
There are
What's going on in the
There are a bunch
1350
of
column?
very severe famines and economic crisis in Europe. Bruce Caldwell is one of the persons who have written books on this. So it's there's also increasingly people think there's a major climate event we're still living with. There was a major rise in temperatures in the early 14th century that turned around agriculture. So we know that something bad happens in the early 14th century. We haven't figured out exactly what the most plausible channel and transmission here is. But yeah, it's a good point. I thought you were talking about post 45.
Yeah, no, sir.
The third one is the North Weingast inflection I mentioned. 1694, the Bank of England comes into play, glorious revolution in England. The classic argument is that we have a new institutional world. We wake up in a world with secure property rights, with empowered creditors who are sure to get their money back when they lend to the government. And they, given these changes, they are much more willing now to lend at low interest rates and reduce these risk premia. So this is another absolutely obvious point to test. And the two remaining ones are in the 20th century. So the 1914 inflection point, I mentioned Mathew and others who have written on the turnaround in world interest rates once the Federal Reserve comes into play and tries to reduce the seasonal fluctuations, but also the multi-century fixed exchange rate system comes to an end. Okay, and we enter the world of floating exchange rates.
What, 1933 when we got rid of the gold standard?
Yeah, of course we have an intermittent period here with gold exchange versions and everything, but the existing claim is that it was 1914 that saw this major turnaround. The final one is 1981, the whole debate about secular stagnation, the change in productivity, the rise of the new economy, etc. These the baby boomer trends that come into play and supposedly turn around all these established trends.
1981 is when something happened in monetary policy. It's the complete opposite of all the other demographic stories. It's, wait, this has to do with money.
Of course, there's a large literature on the specific
That's what
monetary policy, but it's also, it's the time when the baby boomers start entering the workforce and start.
They do that from like 1972 to 1985.
Right.
What happened?
Right. Yeah. Okay.
In these arguments, I get very frustrated with the arguments because you show a graph from 1980 that goes down. Says, look at the great declining trend. Oh, it must be demographic savings level. What happened from 1979 to 1981? Gee, doesn't that have something to do with money?
Yeah.
Why are you testing for this, not this?
For breakout in the level.
Yeah.
Levels rather than slopes.
We test for a break in the mean and the trend. Is that Barbara?
Yes, so I wanted to clarify. Yes, we tested for both a break in the mean and a break in the slope of the deterministic trend. Also, since I'm here, I wanted to clarify a couple of points about the unit root tests that were mentioned before. The unit root tests do not rely on including or not a deterministic trend. So the power to reject the unit root does not require that we utilize a deterministic trend. The ADF GLS test also rejects if you do not include a deterministic trend in the model. Also, there was an earlier point about the fact that unit root tests do not have enough power, but that's not really a concern in this paper because we indeed do reject a unit root. And besides, we use the most powerful unit root test available, which is the augmented Dickey-Fuller GLS test by Elliott, Rothenberg, and Stock. Sorry for interrupting.
Well, thank you very much, Barbara.
We'll follow up on the unit root wars.
Okay, great.
Everyone else will go to sleep if we talk about it now.
So what do we see? So let's compare these two. When we do our break tests, the only two consistent positive breaks that we can identify is 1349 and 1557. 1694, the whole North wine gas story is not even confirmed on any country level. We cannot positively see that. We see on some measures, we do see 1914. For instance, on the US level is expected, it does come up, but far less frequently and strongly than the literature would expect you to see. Okay, so we are not saying that everybody's wrong, Mathew is wrong, and however, you would expect a much more widespread and strong result if really the change from fixed to floating was the key turnaround in the international financial system over time. And if the Federal Reserve inception really had such a massive global impact on monetary policy regimes. Okay. And finally, 1981 really even falls behind the 1914 identification here. We bar one or two variations that we do on the inflation expectations side. We cannot really confirm it in any of these break tests. And so that, in our view, puts some doubt on the narrative that we have been living through a major inflection point in global capital markets in recent decades.
Can you go back to
Which one? This one?
1980? I would think 1981 would be the top of the. Why is 1981 there, not there? My memory of the data is that that's 1981. Oh, because these are real, not nominal. Okay, screams at you in the nominal, not the real.
Yeah, these are real. Yeah. So we think this is a very important observation here. So the last strong structural break on this basis in the international financial system is almost 5 centuries back. Okay, and we test different variations of these break tests. Civet Andrews, for instance, gives you suggested breaks. Some of them impose break dates, other have. So we play around with these different measures, but this is the consistent result we observe, is that there are surprisingly few trend breaks over time on this measure, fewer than you would think, and they are all far back in time, the strong ones. Yeah, and this suggests that really the continuities in sovereign real interest rates are stronger than you would expect. Okay.
So I keep thinking, if you just looked at a few years, a decade later, no, 2 decades later, it would flatten out quite a bit. Why do you choose to start where it is, the middle star?
The start of the series, when we started, you're saying when we started in 1500 rather than.
Well, actually, if you move it to 1620, it seems very flat.
Yeah, like I said, this goes back to Tyler's point. I think that we have tests where we only start in 1870, where we only start in the late 18th century, when also the US comes into play and to be consistent, and we continue to see. So since we're talking about
the States General 1789, help me if I got the date wrong. It's going to be totally flat after that.
Why would that be?
Because I'm just looking at the graph. I'm doing what John's doing. I'm finding the thing where it starts flat, and what happened then, and it looks pretty clear that 1790. So if you make a break in 1790, it's going to be right flat after that.
One thing to remember is we're talking about a glacial trend. Okay, we're talking about 1.6 basis points per year. Okay, so it adds up over a multi-century perspective, but it is hard to see when we look at the short span here. Okay, we're talking about really a glacial trend over time that is consistent, and therefore it's easy to miss if we don't look for it. So it's 1.6% over a century. Yeah, it's not a lot, but it adds up. I might skip 1 or 2 slides. We have 15 minutes left, correct? Okay, great. So we can come back to it, but we look at the low interest rate. So this is a narrative definition of low interest rate errors over time. Okay. Here we have 4 of them identified, and we ask ourselves, is there any regularity here? Is there anything that connects these low interest rate periods? We go through a number of geopolitical explanations and data sets. The one interesting observation is that these are periods with comparatively very low geopolitical stress. The mid 16th century here has a few. The Italian wars are going on in northern Italy, but not much aside. The pre-French Revolution period is pretty peaceful comparatively, compared to the rest of history. And then obviously after 1945, this is often underappreciated, but we are currently living through the longest period of an absence of advanced economy intra-DM wars, if you will, that we can record over this period since the Renaissance. So we can trace it back to an event, the War of Saint Sabas in 1270. So with good sources and frequencies. So the observation is we never had a longer period of peace among advanced economies currently than at least the year 1270. So we haven't conducted rigorous causal identifications here, but it's something that jumps at you when you look at the historical literature and the events. So it seems that periods with very low geopolitical stress, with an absence of war, and there's some intuitive channel that you can think of, are also periods with low real interest rates. So, okay.
Are you going to show us a graph of the nominal rates?
I can.
It's like the nominal rate, like, so what fraction of the changes is attributable to changes in nominal rates versus inflation expectations?
I just want to see it before 1215 hits.
Before 1215.
Before 1215, I'd
Oh, for
love
the
to see
yeah,
a graph
150.
of the nominal yield, not 150. Before the nominal yield, not without your, because I don't trust.
I'll make a note here and I'll show it to you in the before we wrap. I'll make sure. We look at persistence here. So we ask how long does it take for a shock to the global real interest rate to reverse? Okay, commonly known as half-life analysis here. So we find that it takes between 1 and 5 years for a shock to the global real interest rate series to reverse 50% of its deviation, which is a figure that is, I mean, it surprised me a little bit on the low side, but it actually falls within a range of existing work on the FX side, particularly Ken Rogoff has done stuff on the FX side. Obviously, other people have looked at economic historians here like Volker and FX.
All of this we really want to know, just as data fact. Is this how long it takes nominal yields to revert, or is this how long it takes your expected inflation series to revert? Is this about, even if it's completely rightly measured, is this about the reversion of prices back to gold, or is this about nominal interest rates that are surprisingly mean reverting?
Right, I believe we break it down in the appendix, but I do not have it on the slide.
Down on the paper.
Yeah. But it's a good point. If memory serves me, we see it on both the inflation and the nominal interest side. But it's something I'll double check.
I think just more generally, it would be good to show the nominal yields on your inflation expectation series, the one you prefer up front when you make future presentations, because this is a question we all have.
I see, okay. That's noted, so thank you for the comment. I have, like I said, I have the nominal slide here and
Good. Come on, let's see it. Everyone wants to see the nominal.
okay, one more point I want to make before that. So, and I think we have the time, it looks like. So the second part, we try to utilize really the dramatic advances that we've seen in recent years in long-run macro series and long-run macro accounting. What you see here in blue is the estimate of French per capita real GDP made by Angus Madison in his famous OECD series, starting in 1276 and until 1860. And obviously his data is by most macroeconomists, most finance people still regard this as the seminal go-to source for long-run real per capita for all advanced economies. Now in red, you see a new estimate by two Italian researchers, by one French and one Italian researchers, published last year, a new real per capita GDP series for France, starting in 1276. It entirely gets rid of interpolations, is the so-called demand side approach, i.e. ultimately, these are based on real wage estimates and on an estimate of the size of the agricultural sector versus the rest of the economy. There are different approaches. There are also the most advanced approaches are full sectoral output approaches, something that Steve Broadberry at Oxford and LSE pioneered for the UK. But you see the difference is obviously high. It's striking, right? So we can measure output growth on simply a different level nowadays. Okay, and within a decade, it has changed dramatically for all advanced economies. I can show you a different series for Italy, but the point comes across, right?
I guess Madison might have gotten the level wrong, but he's got slope somewhat right. I don't know. You could shift it up, and it would.
He's missing the decline from after the Black Death. So
Yeah.
a steady decline from Black Death to 1600. That's like I'm surprised Madison missed that.
Well,
Even I knew about that.
yeah.
We're not.
Take Madison with a grain of salt or a spoonful.
Is that factoid not true that per capita GDP declined from 1300 to 1600?
It's not, so the red line's not surprising, the blue line was made up.
Oh, okay, yeah.
So Madison relied on interpolations heavily. You can see that obviously, right? So here's a benchmark estimate for the year 1000, and then the next benchmark estimate for the year 1500.
Oh, okay.
1600.
Now we know how he did it.
So I'm interpolating his years here.
Oh, so he's not wrong. He didn't publish that interpolation. We got it.
Yeah, but that's the best we had until 2010, basically. But there's a forthcoming paper for Germany doing the same thing. There's a existing for Italy, I mentioned UK, etc. So this is a treasure trove, I think, that can be exploited in so many ways. It has not reached the finance and econ journals, but we can do very interesting things now and relate these advances to what we're seeing on the financial market side. Okay, and this is what we're doing with just simple correlation analysis for the moment. Okay, we are seeing here in red the global level of aggregate output growth rates. Okay, when we're doing the same sample, the same weighting here for the global sample, and it's visible to the eye that these two series appear to go in reverse directions rather than in the same direction. Correct. So up until the Industrial Revolution, on the aggregate level, not really much is happening. We are hovering around the zero level in terms of aggregate growth rates, and then we lift off. However, the global real rate is declining for centuries already on the eve of the Industrial Revolution. Okay, it has already seen dramatic changes, and the positive association, I think it's nice to see, of real rates and output growth. That's really only something that comes into play in the late 20th century, it seems. Okay, and we have both turning downward. Whereas a ton of the literature would suggest to you that both should be positively correlated. Okay? And it on an intuitive level, in many ways, it makes sense, but it's not the case. We're not seeing that in the data.
You're claiming that ex-ante long-term real rate is sharply negative from about 1920 to about 1970.
So here we're using a Baxter-King filtered.
And you did have a lot of financial repression during that period.
That much inflation.
Yeah, we are taking out the hyperinflation years like Germany, but we are still ending up with a lot of inflation in the interwar period. Remember, this is now a floating regime, and when we look at inflation separately, we would see the dramatic.
It doesn't seem like it should be that negative.
So we're doing the same thing for the
The
population.
nominal
growth.
rates are capped for Second World War.
Yes.
And then there's a lot of inflation between 1914 and 1950.
And I guess this is slow moving enough that this is supposed to be expected inflation, but slow moving enough that it shows up there. Okay.
This is the same chart just with population growth. So this is Alvin Hansen's preferred measure to talk about secular stagnation. the same researchers that make assumptions about these new output series, they have to make assumptions about population as well. Okay, because they're working from scratch and building on the individual level. They're building these estimates. So they come with new population growth estimates as well, which we're utilizing here, and we're also you can see that the line is pretty flat for a long time. These Malthusian dynamics, there seems to be something to it before we accelerate a bit. However, the action is clearly on the real rate side. Okay, for a long time prior to industrial age, and so here we have the simple correlation analysis. We can show based on these series, we are measuring a clear negative correlation of output growth and real rates on the one hand, and population growth and real rates on the other hand. Okay, and we would posit this goes against the grain in many ways, against your assumptions. But in many ways, the post-1980s positive correlation is a complete outlier historically. Okay, it's not what we're seeing regularly. Okay, just maybe one or two. One point I wanted to make across because it came up. So I always get this question about sovereign risk. Is it not simply a sovereign risk? Okay. We have new data sets on private perpetuities. Okay, secured mortgages. Private mortgages are probably the oldest financial instrument of all. Okay, they do exist in the dark ages, even across most of Europe. Purely private to private transactions. Okay, strip out everything about sovereign risk, etc. We can measure them, long maturity, secured voluntary rates for the same set of countries. This is Central Europe, and we are seeing the downward trend as well. Okay, so at least, and we are showing you a couple of other series, corporate bonds that we can measure from the 19th century in the appendix. This is a phenomenon which appears to extend to other asset classes, at least in the fixed income space.
There's also like there's also like a legal story there. I mean, if someone defaults on their mortgage in 1350, you don't have exactly the same recourse to.
Totally. But the point here is that it is not purely a story about sovereign risk if we look at a chart like this, because we are seeing the downward trend, we are seeing stationarity in non-public series as well, okay, to the extent that we can measure them in a good way. So it's not something specific to sovereigns or the public sector per se, that at least we can talk about the slope, okay, and the degree of the decline, but the same basic phenomenon seems to be true for other assets. Yeah. Okay, I have the normal chart in mind, John, but the final one here, obviously we are in a policy working group. So given the policy discussions, if you connect the dots now, what these new series allow you to do is something that Olivier Blanchard has talked a lot about and others. We can obviously piece together for the first time series like R minus G over extended periods of time, okay? And you can argue about things like should we use per capita, output growth rather than aggregate or different basis, but we have R and we have G nowadays, okay? And we can look at both in a new way, in the most robust way so far that we could do that.
Piketty should be celebrating the long run decline in inequality.
Well, there's always been this schizophrenia. R is greater than G when we're talking about inequality, but R is less than G when we're talking about spending a ton of government money.
Right.
We never can make up our mind which one it is.
So Piketty would probably say, I'm looking at wealth returns, that's my R, rather than the sovereign real interest rate. But my point is that for the first time, we can actually construct a sovereign real interest rate minus in very exciting new ways, and we can test new hypotheses with this empirical background now. So 4 minutes left. Let me wrap up. So we think that you can get dramatically superior insights by exploiting new recently released data and the recent advances in finance and econ history. Our new insights about the stationarity of real interest rates come both from using longer samples, which have much greater statistical power. They come from the fact that we use a homogeneous sample rather than splicing commercial paper rates together with policy rates and with T-bills, etc. We're using a homogeneous definition of long maturity interest rates for advanced economies, voluntary rates over time. We do not necessarily reject these short maturity investigations. There might still be different features and channels that make short maturity rates somewhat different in terms of the properties to although the term structure obviously links to them. But potentially there are still safety liquidity features that could make short maturity rates different animal from long maturity rates. However, we think the long maturity is the one everybody should be looking at when talking about secular trends in the economy. And in the final 2 minutes, okay, I think these other points are clear.
Can I
Third-
steal 2 of your minutes?
Sure. Okay.
Well, we're going to see the nominals. Go ahead.
Well, he's
1
fine.
minute.
Here you go.
There are the nominals. Okay. So I think I want to break a lens for liquidity theory here. You were the first person to go and dig out the old interest rates from archives. I remember doing this for the 19th century. And the paper I wrote looked at why it was that yields had trended down from the 1840s to 1914, looking at the plausible explanations for that. And it wasn't like the world had become safer, that default risk had gone down, or any of those sort of explanations. And I finally concluded, and it took me 3 years to figure it out, that capital markets had just become much broader and deeper. And for example, you suddenly had savings banks, which more or less were mandated to hold government bonds. And so I can't help feeling that your story is more plausibly explained by fundamental changes in the scale, in the liquidity of capital markets. That 19th century story has an 18th century counterpart, has a counterpart that goes all the way back to Venice, right at the beginning of your series. Because it seems to me you can tell this story, whether it's nominal or real, in terms of 2 things. Capital markets get bigger and bigger. And you wrote about this in your dissertation, remember, people are accumulating capital a lot. What causes the big spikes? Wars, because then the capital gets destroyed and inflation shoots up. And that seems to me like a sort of sufficient explanation that was there in the earlier work and has sort of been stripped out in this paper.
It's true, because you're totally right. And I mentioned a couple of data points in the paper, right? What would you think the turnover of Venetian long maturity bonds in the 14th century is? It's 30% of GDP. And it's about a third of that debt is owned by international investors of the day, i.e. German abbeys or English monasteries or whatever. So it goes back to 2 things. We are not talking about the drivers. Your point is absolutely valid. There is a separate study to be done. Let's see how liquidity evolves over time. Let's put the pieces together. Nobody has done it, to my knowledge, over really multi-centuries, not Homer and Silla or others. And let's see how well these correlate. And I bet there is a story for liquidity, absolutely.
And I think that would explain also why you're detecting some breakpoints in the past 100 years, in 1914, and to a certain extent 1981. I mean, 70s is when you get, forget about what Volcker's doing. 70s is when you get, the end of the post-war floating but flexible with capital controls.
Yeah, you get open capital markets, huge difference.
And Euro bonds merge, et cetera.
Yeah, but then I would say we end up with another striking result here, if it's really a liquidity story, which is to say, what's going on over centuries and what's going on over the past decades, what is simply a continuing story about liquidity in international financial markets. It has equally nothing to do with population, with Paul Volcker, with all these other factors that have been on the forefront of everyone's debates. And it's suggested whatever happens in COVID, and it doesn't really matter that much for the structural trend. All that matters is liquidity.
Is Barry Weingast on the call?
Yeah, all the demographics and growth rates and productivity and so forth kind of evaporates either way.
Exactly.
This is a very different graph. So the short run volatility is much, much lower. The break points show, I mean, sort of the natural history we all come with. General decline to 1680. That's kind of interesting and nominal. Then everything's flat. Then you get the wars, the Napoleonic Wars, where it's not clear whether governments, that looks like default spreads to me, because you're looking at ex ante yields. And then we all know what happens with inflation, deflation. But you do unit root tests and stuff on this, you can get dramatically different results because you just have so much, all of that was in your prices. So yes, the long-term trends, but the breaks and the effect of short-term price variation. Which ones went to, were those really expected changes in prices? How much very high frequency price variation you had? Anyway, great to see the nominals. You should plot the nominals and the reals on top of each other so you can see how much of that short run fluctuation is due to prices and how much even of the long run stuff is due to the price part, not the nominal yields.
So maybe Barbara remembers, we have done these tests on the nominal rate as well.
So can I jump in here with one more comment on the liquidity effect story, which I agree is the most plausible explanation of what's happening over a long time. But if that's the right story, and if you think liquidity effects are well captured by bid-ask spreads, there's another hugely important implication of the analysis, which is there's not, because bid-ask spreads are so small now on, say, U.S. government bonds, there's no reason to expect a continuation of the decline in real rates. And for policy purposes, that's a hugely important conclusion.
With that, we're already 5 minutes over, and John Taylor said, don't let it run over time. Thank you, everybody.
Well, thank you.